Nippon India Nifty Alpha Low Volatility 30 Index Fund NFO. Will this NFO help you achieve your financial goals? Do you have to give allocation for this NFO in your portfolio? Let us evaluate this one. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors to take a right financial decision so that you can reach your financial goals faster and smarter. Before we dive deep into the analysis of this NFO, first let us understand some key features of this NFO. Then we will analyze the benchmark index, and then we will dive deep into pros and cons of this NFO. Nippon India Nifty Alpha Low Volatility 30 Index is going to simply replicate the Nifty Alpha Low Volatility 30 Index. That means the fund manager in this open-ended equity fund will simply replicate and mimic the Nifty Alpha Low Volatility 30 Index. The fund manager will simply buy the same 30 stocks in the index in the same weightage. There is no additional research, additional customization. He is going to simply cut, copy, paste the index given. This NFO is open till 12th August 2022. It is an open-ended fund. Minimum investment is just 1,000 rupees. There is no entry or exit load. Based on the SEBI's riskometer categorization, this comes under very high risk category because it is an equity fund and the fund manager is Mehul Dama. Investment objective, as I have already told, this fund is going to mimic Nifty Alpha Low Volatility 30 Index. This fund aims to deliver similar returns of the index subject to tracking error and expense ratio. There are some key facts you should know about this particular index. This index, Nifty Alpha Low Volatility 30 Index, selects best stocks from Nifty 100 and Nifty Mid Cap 50. On what basis the selection is done? On few observable data for alpha as well as low volatility. I'll explain you this factor-based investing and what factor we are going to look in alpha and low volatility. I'll explain. Based on some observable data for alpha and low volatility, this 30 stocks are selected. And one important thing in this particular index, individual stock weight is capped at 5%. That means no allocation to your stock more than 5% of the overall assets. So this brings good amount of diversification. Concentration risk at the stock level is very low in this fund. I told you this fund will use factors based on alpha and low volatility. I'll give you a rough idea on what is factor-based investing. First, normally in a broad-based index, only based on market capitalization, free float method, the stocks are ranked and given weightage. No other additional factor is given. Whereas in the factor-based investing, here there are some additional factors which are observable data. Here there is no human intervention, analysis, judgment. Based on observable data, these factors are decided. It can be stock prices or financial information. It has got nothing to do with opinion or speculation, right? Some of the factors could be value, enhanced value, quality, low volatility. These are all momentum. These are all some of the factors based on which the index can be constructed. That is factor-based in investing. In this particular fund, they are not going to focus on one single factor, on two factors. So it is a multi-factor index. It is going to focus on alpha as well as low volatility. First, what is the factor or parameter used to find out alpha? High Jensen's alpha as a parameter is used based on the past 1 year, previous 1 year prices is what they will do. Similarly, for low volatility, what is the parameter used? Low standard deviation of price returns. Right? It is an observable data for 1 year, previous 1 year prices is taken. Based on these two factors, top 30 stocks are chosen. In those top 30 stocks in the index, what are the top 10 stocks? That is what we are going to see in this slide. Nestle India 4.55%, Britannia Industries 4.12%, Tata Consultancy Services 3.85%, Hindustan Unilever, Bajaj Auto, Cipla, L&T, ITC, Dr. Reddy's, HDFC Bank. They also have close to 3% exposure here. So as I have already told, even the topmost weightage is only 4.55%. That means less than 5%. So in the individual stock wise, if you look at it, there is enough diversification. There is no stock specific concentration here. And when we look at it, top 10 are predominantly large cap stocks. Though this fund can invest in mid cap also, top 10 is predominantly mid cap. What is the sectoral allocation this particular index has got? We are paying more attention to the index and dissecting the index from 360-degree perspective, because this is an NFO, there is no track record and there is no portfolio. So it is not possible to analyze the performance of the fund. But being an index fund, it is going to replicate the index. So if we analyze the index, it will give us a fair idea. That is why we are spending more time on analyzing the index. What is the allocation given for different sectors in this index? FMCG 24%, IT 16%, financial services 13%. If you calculate, the overall allocation for these top 3 sectors amounts to 54%. That means this portfolio, this sectoral allocation is concentrated in this top 3 sectors. This brings additional risk. At the same time, it can also bring additional reward in the forms of returns. The other top sectors are healthcare, automobile, oil, gas, construction materials, power. They all have close to 6%. Consumer durables is close to 5.90. Construction and chemicals close to 3%. Sectoral allocation wise, they are well diversified into multiple sectors. What is the kind of performance this particular index has delivered in the past? Quarter to date, this fund has delivered 5.09% negative return. Year to date, this fund has delivered minus 8.32%. Last 1 year, 0.33% negative return. So in the short run, obviously in the last 1 year, recently this fund has given negative returns. Being an equity fund, giving negative returns in the short run is like something which we can expect. So don't invest for any short-term goals, or if you have only short-term money, these kind of equity funds you have to avoid. However, this fund has delivered 12.46% return in the last 5 years CAGR. Since inception, 17.45%. So in the long run, this fund has definitely beaten inflation. We have understood some key features of this NFO. Also, we have dissected this index and understood the index at the 360-degree level. Now, when we did an in-depth analysis on this NFO, we have observed a few positive factors. We also have some negative observations. First, I will list down the positive observations. Okay. This fund has got a well-diversified portfolio. Again, like individual stock wise, cap is 5%, and also sector wise, they are able to diversify across multiple sectors. So this has got enough diversification in the portfolio. Based on few observable data for alpha as well as low volatility, systematically this fund can add performing stocks and remove performing stocks based on the predefined criteria without human intervention. This fund is free from fund manager bias, because here fund manager is not going to do any selection of stocks or what kind of allocation to be given to each and every stock. He is not going to decide anything. In the actively managed fund, the fund manager selects a stock and also gives the allocation to the stock. Based on his analysis and research and his judgmental call, he'll be doing it. If his analysis, research, and judgments goes wrong, then those stocks may underperform. Because of that, his portfolio may underperform the respective benchmark index. This is what known as fund manager bias or stock selection risk. That way, if we look at it, this particular fund is free from fund manager bias, because this here the fund manager is not going to do any analysis, no research, is simply going to replicate the index. Because he is going to replicate the index, mimic the index, there is no fund manager bias here. And long-term investments has got the potential to give you inflation beating returns. Being a passively managed fund, the fund management expenses will be very low. Because of that, the overall expense ratio will be very low. So post expenses return can be better in this fund. These are all the positive observations we had in this fund. What are all the negative factors we had in this fund? Being an investor, you need to understand what is the risk involved in each and every product before you invest. Many a times I have seen investors over focusing on return and going completely out of focus in the area of risk. That is why I'm listing down what are all the negative observations on this NFO. Nippon India, Nifty Alpha, low volatility, that index, right? Conservative investors or beginner investors should consider broad-based index funds. Generally, factor-based investments or smart beta index are for people who have already invested in broad-based index or well-diversified portfolio, looking for additional risk-return trade-off. So this is suitable for slightly aggressive investors. Though this fund can invest in mid-cap also, as of now, based on the parameters, it is a large cap heavy portfolio. Because it is a large cap heavy portfolio, if there is a continuous rally in mid-cap and small cap segment, this fund may outperform flexi cap funds and mid-cap and small cap funds. Being an index fund, this fund is not capable of outbeating the market or index, because the job here is to mimic the index and replicate the index and provide similar returns. Whereas in the actively managed fund, the fund manager will analyze all the stocks in the index. He will choose the best stocks. He will avoid the below average stocks. Because of that, he will be able to outbeat the index. Scope to outbeat the index is there in the actively managed fund, which is not there in this index fund. Here, the fund manager will not be able to do any dynamic allocation based on the market outlook. If the market outlook seems to be in favor of mid cap, moving from large cap to mid cap, or if the outlook becomes brighter on large cap, then moving allocation from mid cap to large cap, or within the sector, like changing the allocation based on the market outlook, it is not possible. No in-depth analysis of underlying stocks. In the actively managed fund, the fund manager will pick and choose the best stocks by doing his own analysis. He will study the balance sheet. He will study the sustainability of the company, profitability of the company, cash flow, whether the company or sector is easy to disrupt or not, what is the value addition, value proposition the company has got, a competitive edge the company has got, capital efficiency, all those things the fund manager analyze and choose the best stocks. Whereas here the fund manager is not going to do anything. He is not even going to simply look at the balance sheet. He is going to look at the index, what are all the stocks, what is the weightage, he is going to replicate. Why do we go and invest in a mutual fund? Because we don't know how to select a stock, fund manager knows. But in this fund, though the fund manager knows, he is not going to apply his knowledge here. He is going to simply replicate the index. And because of that, the fund manager is forced to take a blind risk. Whereas in the actively managed fund, the fund manager can pick and choose the best stocks and best sector. Here, even the fund manager knows this is a poor stock or this is a poor sector. He's forced to invest in that sector because that sector and that particular stock is there in the index. So there is no scope for taking calculated risk by the fund manager here. Fund manager has to blindly follow the index. As an investor, one strong advice what I should give is you should always take calculated risk. You should not take blind risk. Taking calculated risk increases your margin of safety and reduces downside risk. One important drawback of index funds is because of tracking error and expense ratio, they underperform the respective benchmark index itself. This fund is not flexible, will not do any course correction during market correction or market rally. Right? Generally, during market fall, fund managers change their portfolio into different stocks. Similarly, like during recovery, fund managers will change the stocks into momentum stocks. These kind of active management is practically not possible in this fund. These are all the negative observations of this fund. Now, do we have to invest in this fund or not? It depends upon what kind of investor are you and what is your expectation. Right? This fund is suitable for aggressive investors and not for conservative investors because they have to invest in broad-based index or well-diversified fund. And this fund is suitable for aggressive investors who's looking for, who's not willing to invest in active managed funds. As an aggressive investor, selecting good actively managed fund is not in your circle of competence, or it is not in the circle of competence of your financial planner or investment advisor or mutual fund distributor. Then in that case, you can stick to passively managed funds like this. If you are looking for dynamic fund management, you should avoid this fund. If you are looking for other opportunities, because in the long-term investments, actively managed portfolio can produce better returns. Also, there are existing funds which are mimicking this index. Nifty Alpha Low Volatility 30 Index funds are available already from other mutual fund companies. They have a proven expense ratio and tested tracking error, right? So we know what is the kind of expense ratio they have, what is the kind of tracking error they have. So one thing what I want to give you is, if at all you want to invest in this index, choose existing index funds with a good track record. Whereas this is an NFO, we don't know what kind of expense ratio this fund is going to have, what kind of tracking error this fund will have, we don't know. Again, we have to take blind risk from the expense ratio and tracking error perspective here. If you are looking for market beating return, again, this fund is not suitable for you. If you want to invest in this fund or avoid this fund, please consult your financial planner before taking such a decision. Why? Because your financial planner knows your complete financial roadmap. Where are you financially? Where you want to go? You want to repay your loan, you want to buy a property, kids education, kids marriage, your retirement, from retirement to life expectancy, getting regular inflation adjusted income. These are all the major milestones. What is the cash flow you have now and you can bring in till your assumed age of retirement? Combining that is what the financial roadmap a planner has created. In that financial plan roadmap, in that financial goals, that investment objective, whether this fund is a good fit or not, he'll be able to decide. Also, based on your risk appetite, based on your risk profiling, and based on your risk-taking capacity, this fund will fit in your portfolio or not, he'll be able to decide. Also, one more thing you can ask your financial planner is, you already have a set of mutual fund portfolio. You also have a direct stocks portfolio. Because you are going to add this Nippon India Nifty Alpha Low Volatility 30 Index Fund, is it going to bring overlap or is it going to bring unique diversification? This overlap or unique diversification is going to be beneficial to you or not. So this analysis you can ask your financial planner, and based on his suggestion and the answers to his questions, answers to your questions from him, you will be able to take a decision. Hope our analysis on Nippon India Nifty Alpha Low Volatility 30 Index is complete and comprehensive. If you need any additional information on this NFO or any other investment options or anything related to achieving your financial goals, feel free to book a free appointment with our certified financial planner. To book a free appointment with our certified financial planner, I have given a link below this video in the description. In the description, I have also given you one more link. It is for our upcoming webinars. We regularly organize insightful investment webinars with eminent investment experts. They share long-term investment strategies and wealth creation techniques which you can learn and quickly apply in your portfolio. If you want to participate in our webinars for free, just leave your name and email ID. Our team will book a seat for the upcoming webinar and send you the invite. Hope you like this video. I'll again meet you in yet another useful video. Thank you. Bye-bye.